I had a request from someone that wanted me to show them how to report rental income. So in this example, we have a rental property. Let's just say it was already in service. They made 36,000. Well, first, it's a long-term rental. There's going to be different rules for the short-term rentals, midterm rentals, and long-term rentals. But I think the most common one is going to be a long-term rental. And this one is rented out for the full year. Made $36,000 of rental income, $1,000 in cleaning and maintenance, $600 for insurance, $500 legal and professional, 10% for management fees, which is 8-10% is common for management fees. This is going to be from the tax form. I'm going to assume $20,200 for mortgage interest, $1,000 for repairs, taxes are $3,300, utilities is $250. So this is something your client should provide you, that they tell you what they spent on all these things. The mortgage interest is going to be based off a tax form. Taxes should be on the tax form. If not, you can look it up on the county recorder's office or treasurer's office. And so all that information should be on there. Your depreciation should be in the tax software, as well as your amortization for the loan costs. And so in this example, there was a rental loss of $8,600, primarily due to due to everything, but it's like mostly the depreciation, I would say. I mean, obviously there's mortgage interest, but it puts him in a rental loss. And most people have an income, or not income, but W-2. And in this scenario, they made $100,000. Since they make less than $100,000 or $100,000 or less, they can take these rental losses. There's a rule that if you actively participate, which is different than materially participate in your rental, and you make less than 100 grand or 100 grand or less, you can deduct those rental losses. So there's no limitation on that. So in this scenario, they made 100 grand, they're single, reduce that, standard deduction, and their tax on that is about $11,274. I didn't do any income withheld. This is just primarily focusing on just rental income. So that in this scenario is beneficial for the client in terms of taxes, because they get reduced as $8,600 of rental income. Now, if they made $200,000, now that they're over the $150,000 threshold, everything in between $100,000 and $150,000, there's like phase out amounts, but I'm just going to go with $200,000, so it's way past the threshold. And so therefore, your rental income, or these losses, are going to be suspended, so it's going to be carried forward. So you have 8617, so you can't take any of these losses, and therefore this person, D52, that will state 8617. We'll just pretend 8617. So also, I did this for Nevada, so we don't have any state income tax. But if you did have state income tax, what could be different is going to be whether your state conforms to bonus depreciation or not. So there could be differences between federal and state in terms of like the rental loss or rental income. I know California doesn't conform to bonus, so it would be different. In this scenario, I'm using Nevada, mainly, like I said, to show the taxes at the federal level. So in this scenario, since they make over 150 grand, 200 grand, they just pay tax as if the rental activity never even happened, because now they have about $8,600 carried forward. And so next year, if they do have income, then they can offset that income with this carryover loss. So yeah, those are the two main ones where you are able to use the rental loss against your income, and scenarios where you don't. Oh, and then also, I guess if you or your spouse is a real estate professional status, then that means you are working 750 hours or more in a real estate trade or business. Think like real estate agent, property manager, real estate development, and you can make more than that. You just have different rules. You also have to materially participate in the rental, which means you are spending anywhere from 500 hours or more on the rental property itself, or 100 hours or more and those hours have to be more than anybody else on the property. So different ways. So if they are real estate professional status and they made 200 grand and one of you qualifies for real estate professional status, then you would still be able to take these losses. Now, if it's the first year that you have this rental, you're going to receive like a settlement statement from the title company, and it's going to show the cost of the building. There's going to be some, title expenses, some loan costs, and I have this little template here. You'd put in like the amount that the purchase price was. All these title costs are going to just add to the cost of the building. So it add to the cost of the building. All these loan costs are going to be amortized over the loan, which is typically over 30 years or 15 years, depending on which type of loan they get. Then there may be some expenses that are prorated and paid. And so these ones are most likely going to be expense on Schedule E. If it's housed in a partnership, then this is going to be on 8825 tax form. So all these numbers when you input in here should match your HUD statement. Oh, and then the land improvement value. You would look on your property tax records to see how they break up the land value and improvement value. So in this scenario, land and building is almost 80-20. This is just an example. I just threw together some numbers, but usually it's about 80-20, could be 30-70. And so this is helpful for the first year. Once you have all this information and you input all this stuff in the tax software, it's going to already spit out the depreciation and amortization for you. And then each year you just have to update the rental income and all these expenses, as well as get the tax forms for the interest for that property. I'm not going to go over the states just because depreciation for each state is going to be different, and I'm just focusing on just helping people understand just the rental income aspect of this. Hopefully that was enough information. If not, please let me know in the comments.